Estás en mute.
So there we go. We were going to wait for 2 minutes, but I think we're fine now, ready to start. I'd just like to thank everybody for joining this morning. It is always a pleasure to work with the CFA Society, and today we have the luxury of collaborating with both the CFA Society of Uruguay and the CFA Society of Mexico. And we were going to be discussing the challenges faced by emerging markets and by our region in a global tightening cycle, and this heightened by the crisis we currently have in the Ukraine and Russia. So with me today, we're going to have a panel of moderators. So Fabián Ibarburo, he's the CEO of the CFA Society in Uruguay and the CEO of the CAF-AM, the Development Bank of Latin America. So thank you very much, Fabián, for joining us today and moderating the Q&A session that we'll have at the end. And we also have Sebastián Miralles from the CFA Society in Mexico. He's the director of events of the society. He's also a board member and one of the founding members of the society. So it's really a pleasure to have him. He's also a managing director for Tempest Capital. And for you that, for those that are new to Colchester, just a brief background on us. We are a UK asset manager focused exclusively on sovereign debt and currencies. And we cover the full spectrum. So all the way from developed markets, emerging markets, inflation-linked bonds, and frontier EM. So without further ado, I would like to introduce Fabián. Just in terms of the way that this will run, we will have a short presentation by Cian. He's a senior investment officer based in Dublin. He's part of our investment management team. And then we will have a Q&A session where I would really welcome you to join by sending questions via the chat. We know that it's a relevant time to be discussing our region and to be discussing the impact of the current events on our inflation outlook and on our prospects for, the sort of broader LATAM. So we would very much welcome that. The presentation is going to be entirely in English. If you do send questions that we don't have the time to go through in the presentation, we will anyway answer them and then send them back to you through the CFA Society. So Fabián.
Well, thank you, Analia, and welcome. I'm seeing many members of the CFA Society in Uruguay, and thank for joining here, and please do the questions you want to. This is a go and back session, so and of course we are all worried about inflation, also about the war, so let's see what's happening.
All right, thank you everybody on behalf of the Mexico CFA Society. Again, this is an extremely timely event given the volatility arising from the war. Also because of the impending shortages of commodities, that was an ongoing theme before the situation. A lot of moving parts. The world has really changed for us in the past 2 weeks, and we look forward to having this perspective on emerging markets and the Asian market in particular, which sometimes seems very distant for Latin American portfolio managers. With us, we're going to have Cian O'Brian. He's a Master in Science and CFA Senior Investment Officer and CFA Senior Investment Officer at Colchester Global Investors since 2013. Cian manages both developed and emerging market bond portfolios and conducts sovereign balance sheet research at the firm. Cian graduated from the University College of Cork with a degree in commerce in German before obtaining a master's in investment and treasury from Dublin City University. He is a CFA charter holder and a member of the CFA Society of the UK. Cian is Dublin-based, and ideally an ideal person to tell us, give us an insight into the balance sheet issues that countries like China and Russia might be facing currently. Please, Cian, Sean, please, stage is yours.
Thank you, Sebastian. Good afternoon, or good morning, I should say, where you are. It's great to be here today, speaking to all of you at what is clearly, I guess you could say, an interesting time. Interesting might be the wrong word, given the tragic events that are happening in Ukraine. But from a financial markets point of view, there's an awful lot going on. From a political and geopolitical standpoint, there's an awful lot happening and an awful lot of uncertainty. So in that regard, it's certainly timely to look at some of these issues: inflation, how that impacts on emerging markets, on bond markets, and currency markets in general. So I'm going to share my presentation in 1 second. I'm going to talk, I think, for not very long, for maybe 20-25 minutes. And then certainly I would welcome any questions that everybody or anybody has, and ideally to make this as interactive and as useful to you as possible. So just 1 second while I share my screen, and hopefully this will work nicely. Let's see. Okay, so hopefully you can see the presentation, the first page, challenges for emerging markets. Let me just scroll through the first couple of pages. And so I wanted to begin really by talking about the global inflationary backdrop that we're faced with today, then touch on the sensitivity, if you like, of emerging markets to monetary policy in developed markets, and in particular in the US, because obviously up to a few weeks ago, one of the key challenges facing emerging markets this year was the normalization of policy in the US. Then we're going to look at some of the fundamentals, balance sheets within emerging markets, because I think that's key to understanding the sensitivity or the vulnerabilities today. And then obviously look at what's happened in the Ukraine and the implications of the Russian invasion of Ukraine. So I'm just going to go through to this chart to start with and set the scene for global inflation. So as I'm sure you're all very aware, for the past 12 months or so, there's been a significant increase in the rate of global inflation, first assumed, if you like, to be transitory, now clearly something more persistent than had been thought. I think what's important to focus on in this chart is the fact that the global inflation backdrop is by no means a uniform one. So before this recent surge in commodity prices, what we were seeing, in our opinion, is significant divergence in the rate of demand-driven inflation, if you like, with those economies where post-pandemic stimulus had been strongest, experiencing the most significant increase in inflation. And in particular, in Asia, something quite opposite was taking place, relatively low and stable inflation. So that was one of the themes that we were seeing, at least before the Russia-Ukraine conflict emerged, was this divergence in global inflation between the Americas and Europe on the one side, seeing significant upward pressure on inflation, and Asia, on the other hand, really driven by what's happening in China, but generalized low inflation across the Asian region, I would say. Then just to focus on the US a little bit, I think this is probably something that people will be very used to over the past 12 months or so, this divergence between goods and services inflation. I think this really tells the story of what happened in the past 12 months, in the sense that the initial spike in inflation was to a large extent driven by goods price inflation and was very much a function of the pandemic itself and the reopening after the pandemic, amongst supply chain issues, the shift in consumption patterns during lockdowns, etc. But if you look at the rate of core services inflation in the US, that has been ticking up quite significantly. So I think this was really the message at the end of last year, that the rate of inflation that we were seeing in economies like the US was no longer just a story of goods prices. It was no longer a story of the pandemic. Rather, we were now seeing it in services price inflation. It was a demand-driven inflation, given strong growth, healthy labor markets, and rising wages, etc. You can see that in the next chart in terms of job vacancies in the US and the UK, so the strength of the labor market. I'm going to move quite quickly through some of these charts just to give you that broad picture that was prevailing in terms of inflation, at least up to around a month ago. Again, looking at the US labor market, very significant signs of strength in the labor market, potentially even overheating. A low level of unemployment and that sharp increase in the quits rate, which tends to correlate with a very, very strong, hot labor market. So that's the global backdrop, if you like, up to recently. It was really one of strong labor markets, rising wages, and upward pressure on inflation in North America, in Latin America, in Europe, but certainly much less the case in Asia. And that was one of the big themes that we were seeing across global markets at the beginning of this year, that divergence. So now let's just take a look at emerging markets. What does it mean for emerging markets when we see the prospect of tightening monetary policy in developed markets? Because clearly, the implications of what we've just seen, very strong labor market in the US, falling unemployment across Europe as well, demand-driven inflation, clearly the reaction from policymakers to that backdrop will be to tighten monetary policy. And history tells us that a tightening of developed market monetary policy, particularly in the US, tends to coincide with economic and financial difficulties for emerging markets. And this goes right back to the Asian crisis in the late 1990s. But more recently, of course, we saw it in the middle of 2013, when Fed chair at the time, Ben Bernanke, talked about a tapering. At the time, it was only a potential tapering of Fed purchases. That led to a spike in US yields and led to a period of significant volatility and depreciation of emerging market currencies, with a particular focus, I'm sure everyone will remember, on the fragile five. Of course, the key word here, I think, is fragile. And one of the points that we want to make today about emerging markets is that in general, in aggregate, this fragility that prevailed back in 2013 is not the case today. The balance sheets of these economies in general have improved quite significantly. And so the vulnerability to a period of monetary policy tightening in the developed world is much less than it was back in 2013. This just shows you briefly what happened to those fragile 5 currencies starting in May of 2013, a very significant depreciation, and almost 50% depreciation of the nominal exchange rate in Brazil, for example, at one point. Just very briefly, how does or why does monetary policy in the developed world, in particular in the US, impact so much on emerging markets? Well, probably the most significant channel is through what I've called here the risk channel. So you have the risk channel, namely being the level of sentiment, if you like, amongst investors. And what you tend to find is that when policy or rates are likely to move up in the developed world, investors become more nervous about exposure to emerging markets, look to shift capital back to the now higher level of rates prevailing in the US, for example. And that's very much the story of what happened in 2013. But it's not necessarily always that simple. So I think we need to consider the broader economic backdrop. In an environment of strong global growth, you're going to see a positive impetus to emerging markets from trade. You're going to see that investor sentiment supported by the positive economic backdrop. In other words, the broader context matters. It's not as simple as Fed policy tightening equals a depreciation of EM currencies or an underperformance of emerging market assets. That's the key point we want to make. And secondly, some countries are more vulnerable than others. And ultimately, those with weaker balance sheets, fiscal and external, weaker policy frameworks, weaker governance are likely to be more exposed. And that's why it's important to look at the fundamentals in EM today. And this is where we see a significant divergence between what happened in 2013 and the current environment. So a couple of examples of that changed economic backdrop. Firstly, the levels of debt, fiscal balance sheets. Whilst we have seen a material increase in the level of government debt, the servicing cost has remained relatively stable. In other words, as debt levels have gone up, the level of interest rates on that debt have come down, such that the servicing cost to governments has remained relatively stable. And more importantly, I think, is the external balance sheet. This is where we've seen a significant shift and improvement since 2013. So very simply, what we're showing here, I'll just briefly describe the chart. We're showing on the horizontal axis the level of real exchange rate under or over evaluation against the dollar. So this is our own estimate of the real exchange rate in each economy and whether it's overvalued or undervalued against the dollar. A positive number suggests that currency is overvalued. And what's happened since 2013 is that emerging market currencies in general have weakened, have depreciated from levels that were somewhat overvalued in real terms to levels today that in almost all of the major emerging markets are undervalued. At the same time, if we look at the external balance sheet and we look at a measure of reliance on global capital flows, so this measure that we use is the current account. So the current account on the balance of payments adjusted for net foreign direct investment. So it's a measure of how reliant is a particular economy on portfolio inflows. And again, we can see a shift from 2013 to now, an improvement from deficits to surpluses. In other words, emerging markets in general today are less reliant on global capital inflows. So ultimately, what's happened? Currencies have become cheaper, balance sheets have become less reliant on foreign capital. And if you put that together, we would argue that the exposure today of emerging markets to negative external shocks, whatever they might be, that exposure is significantly reduced. Doesn't mean that you can't have a negative shock, that you can't have a depreciation of the currency, but it suggests that you're in a much better starting position, and therefore the impact is likely to be much less. And just to put that currency valuation into context, we've got here a chart over time of the average over or under valuation of the currencies within the standard local currency emerging market bond index. So the index is the JP Morgan GBI Emerging Market Global Diversified Index. We take all of the currencies within that, and we take a weighted average of their real exchange rate valuation, so over or undervalued against the dollar. And what you can see is that if you look at 2013, the line is above zero. In other words, on average, the asset class EM currency was overvalued. But then as you go through that period of falling commodity prices and tightening policy in the US, you see emerging market currencies weakening. Then obviously 2020, first quarter of 2020, you see another significant leg down in emerging market currencies. And we're not particularly far today from where we were in March of 2020. A level of real exchange rate undervaluation to the dollar that is, by historical context, quite extreme, and suggests to us that EM currencies actually are more likely, I should say, to strengthen than to weaken over the coming years. I might just skip through the chart on real yields for the moment, and we can come back to that during the Q&A. I just want to make a couple of points about inflation and what's happening right now with commodity prices. Firstly, I think it's very important to remember that there has been a structural improvement in the inflation and monetary policy framework within major emerging markets over the past 20 years. You can see on the chart a simple demonstration of that, how over time the average level of inflation has come down. That's coincided with an increased credibility of monetary policy, the adoption of inflation targeting by many central banks within emerging markets, and ultimately a more orthodox policy setting, you could say, both fiscal and monetary. So your starting point, if you like, today for many emerging markets is a relatively good one in terms of the level of inflation and the credibility of monetary policy. Clearly, the huge shock in late February with the invasion of Ukraine by Russia has upset a lot of forecasts for the year and changed the backdrop significantly. If we think about where we are today, the outlook for the Fed remains unchanged. So very simply, if you look at market expectations, what happened is in the immediate aftermath of the invasion, markets priced out a couple of rate hikes. That's more or less come back into the expectation now for this year. So we're pretty much today at the same expected Fed funds rate for the end of the year as we were in January of this year. So what's happened hasn't derailed the expectations of Fed tightening. But I think what's important in terms of the emerging market environment is that emerging market central banks have already tightened policy. So as you'll be well aware, in Brazil, for example, in Mexico, in Colombia, central banks have already acted preemptively, you could say, and quite aggressively to tighten monetary policy. And you can see on the right-hand chart of money supply growth that in general, money supply growth has not picked up significantly in EM. You did have that spike in Brazil, but it's now back more or less to the long-term average. So I think the policy setting in emerging markets today is, if you like, is already or has already moved quite significantly even before the Fed has started to tighten policy. You can see that here in terms of what a number of central banks have done. That, I think, again, gives something of a cushion, gives something of a layer of protection, if you like, to these emerging markets in terms of the potential negative shocks that are going to come from the spike in commodity prices, obviously, as a result of the conflict in Ukraine. So the impact of what's happened on EM can materialize through a number of channels. Obviously, the hit to investor sentiment and confidence, that can impact on flows to EM, higher commodity prices, and then you have global growth and global trade. To the extent that what's happening is impacting negatively on growth, that will impact on trade and demand for exports from emerging markets. In our opinion, that impact is not uniform. So certainly in Latin America, there are some signs that the impact is a lot more nuanced given that exposure to commodity prices. So you can see that year to date in the behavior of currencies. Whilst most emerging market currencies have weakened year to date, the Brazilian real, the Colombian peso, the Peruvian sol have all rallied quite significantly. So markets are focused quite clearly on the divergent impact of what's happening. Currencies in Eastern Europe are performing particularly poorly. Czech koruna, Polish zloty, Hungarian forint, not just because geographically they're close to Ukraine and potentially vulnerable, but also because they're significant commodity importers. The commodity exporting economies have largely seen their currencies strengthen. And what this means is that the strengthening currency acts to offset quite a significant degree of the inflationary pressure that would otherwise come through from higher commodity prices. So just by way of example, I'm just looking here at one Latin American economy, which is Brazil. And you can see there's quite a good relationship there between the level of inflation in Brazil and commodity prices in local currency. So I think it's important to look at commodity prices in local currency terms when we're considering the impact on domestic inflation. And quite interestingly, what's happened in the past few months is that the rate of commodity price growth expressed in Brazilian real has come down. So ultimately, the impact on inflation in an economy like Brazil is likely to be offset by the strengthening currency. And so the ultimate exposure or vulnerability, I think, in economies like Brazil and the rest of Latin America is significantly reduced compared to an economy like Hungary or Poland or any of the other emerging markets that don't have that significant commodity exporting sector. So in the interest of time, I really wanted to leave it there and open it up to questions. The few conclusions that we've come to, so clearly what's taking place in Eastern Europe is likely to result in higher global inflation and lower growth. The policy tightening in developed markets is likely to continue. But when we look at emerging markets in general, we see that their balance sheets are in a stronger position than they were back in 2013. Monetary policy has generally reacted already and tightened. Exchange rates are undervalued compared to the US dollar. And looking at Latin America in particular, it offers relatively attractive real yields, we think, in terms of the local currency bond markets, and also that positive exposure to rising commodity prices, which offsets some of the negative implications of what's happening in Ukraine. So let me pause there and see if there are any questions or comments on what we've done, what we've gone through.
Right. Cian, thank you very much for the presentation. So we will now open up the floor for questions. Let me start with one. So with balance sheet, speaking directly about emerging market balance sheets, there's a big differentiation between countries that have mostly local denominated debt and international US dollar denominated debt. How do you see that playing out? How with regards to your analysis?
Yes, well, in a sense that vulnerability goes all the way back to, well, at least back to the Asian crisis, 98, when the Asian economies were exposed by that reliance on short-term hard currency borrowing. And clearly one of the lessons of the Asian crisis, and it's come up again numerous times, most recently perhaps in Argentina over recent years, the vulnerability associated with a currency mismatch between your assets and liabilities is a significant risk. It's one of the indicators that we look at in terms of balance sheet strength. What I think is relevant to us as bond investors is that most of the major issuers of local currency debt have shifted their funding model quite significantly to that particular source, as in local currency debt. Most of the Asian economies did that originally after the Asian financial crisis. So we're quite comfortable with balance sheets and currency mismatches in Asia. I think in Latin America, if you look at somewhere like Brazil, the vast majority of government debt, for example, is in local currency. I think that's a significant strength. And it's a similar story across the economies that we look at least. Brazil, Colombia, Mexico, we're not Chile, Peru, we're not materially concerned about the level of dollar debt. I think all of these economies have shifted their funding model, as I say, and therefore it's not a particular concern. It is a concern in individual markets. So we've seen crises blow up in recent years, Lebanon, Sri Lanka, Argentina before that. Not markets that are particularly significant in the global sense, and not significant portions of the typical local currency benchmark. So I think that's the key. The markets that we are looking at, we're not particularly concerned about high levels of dollar debt. I think it's more of a concern for what you might call the smaller frontier type markets.
Okay.
We have a question from Eduardo Fonseca. Do you see a risk of stagflation given the current economic outlook?
Stagflation is
But by the way,
certainly,
please raise your hand. Any other questions, or text them directly to the group chat.
so yes, on the question of stagflation, it's certainly a topic that's getting a lot of attention in the media. I think as of right now, stagflation is not the most likely outcome, as in what we're seeing is upward pressure on inflation, yes, but that's coinciding with up to now a relatively robust growth environment. So that's not stagflation, that's high inflation and relatively robust growth. That's the situation we have right now. There is a question mark, obviously, over the growth outlook to the extent that what's happening in Ukraine lowers that growth profile. I think there's some validity to the argument that the growth will be lower than we thought, but I think it's still likely to be a relatively robust outturn, and therefore stagflation is not the appropriate description. I think it's more a combination of reasonable growth and high inflation.
Okay. Fabian has a question for us.
Okay, thank you. Cian, what if, as a scenario, if there is no other way that to a significant spike in the rates, I mean in America or Brazil or Uruguay, as the only way to temper inflation, how would it impact a breakdown in the labor markets or price of goods, housing, commodities?
Yeah. I think I'm just going to go back to one of the early charts. So certainly the early stages of the increase in inflation last year, driven by goods prices, in that kind of environment, and commodity prices fall into the same category, there is a view, and a reasonably valid one, that monetary policy cannot really tackle rising prices of goods driven by supply constraints or the higher cost of shipping. Similar story with commodity prices. Does a higher rate of the Fed funds rate lower the oil price? Not directly, but I think we're now at a stage where the level of real rates is extremely low, and the level of real rates is fueling higher wage growth in the labor market, and ultimately there's a balance to be struck there by policymakers. I think in order to prevent a more aggressive tightening down the road, they need to start tightening now. In fact, maybe they should have started tightening already. So I think the impact of higher rates will be felt on wage growth. So it will lower the pace of wage growth. It doesn't necessarily impact on commodity prices in the near term. It might do again if markets believe that tighter policy is going to constrain growth and reduce demand. It might reduce commodity prices. So it doesn't solve all of the inflationary difficulties that we're seeing, but I think it will, just looking at this breakdown between goods and services, for example, it will have an impact on service price inflation and wage growth. And that's, I think, necessary at this stage, because otherwise the danger is that inflation expectations become unanchored and you actually end up with a more significant monetary tightening at some point in the future.
All right. Please, any further questions on the chat or, okay, we have one question from Alejandro Duran.
Hi, do you hear me?
Yes, I can hear you.
Okay, let me push back against the narrative the policy, inflation policy mistake, because we are watching now very clear events that took place in the 1970s. The monetary policy in Europe, especially in Europe, but also in the US, is quite relaxed at this point. The real interest rates in those places is extremely low, extremely negative. And you have the oil shock, and you have an economy which is both in the US and Europe not reacting to positively. It's actually getting weaker, and the same goes with the rest of the developed economies. At least in Mexico, it is clear that the economic activity is weakening. So the fact is that you may see a postponement or a low commitment on monetary policy tightening, and therefore a protracted period of inflation and weak or even negative GDP growth in the developed world, and consequently over the commodity prices all over the world. And that's more or less of a comment, but I would really want to learn about your view on Mexican real interest rates going forward. Then again, we have in Mexico a very negative real interest rate, even as the central bank has pushed the interest rates up. We are still way behind the curve, and one wonders what would be the future, because there are voices even in the private sector suggesting that we have to pause the monetary tightening already underway. The more so when you see investment, and the general business outlook is quite weak in the country. Not in let's say in macro indicators, we are doing well in that respect, but we are not doing well in the general sentiment of business and politics.
Sure. Okay. So there's quite a bit in that. I think, firstly, in terms of the oil shock and the 1970s comparison, and I think this is relevant also for Mexico and the debate around the appropriate level of tightening. I think that economies today are fundamentally different to those in the 70s, and the pass-through from oil to inflation, for example, is significantly lower. So the risk, I think, today of a significant spiral of higher inflation and higher wages, such as happened in the 1970s, is quite unlikely, partly because of the changing structure of labor markets, so more flexibility in labor markets, a lower reliance on oil in the first place, greater credibility of monetary policy. So I think that's the backdrop today. I think that policymakers also have to balance growth and inflation, and to that extent, that inflation is driven by factors outside the control of monetary policy. I think, again, it's possibly appropriate to have a negative real rate today on the basis that at least some of that inflation is not going to persist. Some of it will, or some of it potentially will. So an element of tightening is appropriate. But I think policymakers are are struggling to get that balance right. And it's not clear to me if there will be a policy mistake, in which direction it will be, because it could be in either direction. It could be a mistake of over tightening. If we do end up with commodity prices, for example, reversing at some point later this year and growth slowing down, obviously policy won't want to over tighten into that environment. I think specifically on Mexico, then there are issues around domestic policy and the domestic investment climate and business climate that are probably weighing on growth. But again, I think from where we're sitting as bond investors, we think that, let's say, the long end of the curve in Mexico, for example, offers value to us on the basis that the medium-term inflation profile is probably still somewhere between 4 and 5%. So on that basis, you have an attractive real yield over the long term. That leads us to overweight Mexican rates, for example. It's not necessarily a positive outlook for growth in Mexico. So I think, as you say, there are micro issues there regarding the investment climate and business climate. But in terms of inflation per se, in our opinion, the level, the setting of monetary policy is probably appropriate. And actually, we think that inflation is going to, over the next year and a half or so, inflation is going to stabilize and come back down, not just in Mexico, but across Latin America. And I think that underpins, at least for us as government bond investors, that underpins a number of overweight rates positions that we have in local markets in LATAM economies.
Thank you. Any further questions? Okay, perhaps I can throw one last question, and unless somebody else wants to jump in. So in Mexico, there's now a lot of talk about nearshoring, and given the trade relations between the U.S., the dislocation between U.S. and China. How do you, and you mentioned that currently there is a difficult business environment for political reasons. How do you see that playing out? Is it something you're looking at?
It is something that we've thought about for some time. I mean, it's clearly a potential implication of the pandemic over the past few years, and also the increasing, I would say, fragmentation of the global economy. A trend towards onshoring should continue and should benefit, you would think, an economy such as Mexico. But then at the same time, you have the micro country specific issues at present. Nonetheless, I think on balance, it probably does benefit the Mexican economy over the medium term. I think the big picture globally is that we're going to see some continued fragmentation is the wrong word, but continued focus on supply chain resilience over supply chain efficiency. So for many years, supply chains were purely focused on efficiency. That benefited Asia in general and China at the cost of resilience, as the pandemic exposed. And then you combine that with, I think, an increasing polarization of global politics. And I think that combination suggests that you're going to see continued focus from corporates on onshoring of activity. And so I think on balance, that's certainly a potential benefit, an opportunity for an economy like Mexico. Doesn't mean that it's necessarily going to come to fruition, because it does require some element of domestic policy accommodation as well. But I certainly think the global trend is there, and it's just a matter of whether economies like Mexico can avail of that trend or not.
Thank you very much, Cian. So the and I'm sure I'm terribly mispronouncing Gaelic. Any other questions? Do we have any other questions from the forum? All right. So I think with that we can conclude the Q&A session of the event. We would, I would very much like to thank you and thank Colchester for the very interesting perspective on emerging markets and sovereign debt. Of course, your contact details are available, and I would welcome some closing remarks on your part.
Well, thanks, Sebastian. It's been great to be here. From my part, at least. It's been a pleasure to talk to everybody. Thanks for your time. Thanks for the questions. And my colleague Analia, have you a few words to wrap up?
Just thank you. Muchas gracias a todos. Thank you for joining us. And we will be sharing the presentation that Cian did today with the CFA Society in Mexico and Uruguay. So you can request a copy if you're interested in having some of that data. So just sending you everyone a big thanks for joining us again, and see you next time.
Thank you very much.
Thank you.
Thank you, everyone.
Analia, Cian, bye-bye.
Bye.
Thank you.
Gracias.
También.
Thank you. Bye-bye.